Holdings and Zoom Video are two interesting growth stocks that I wanted to compare and decide which one I think is the better investment for long-term investors. I'm going to share with you the comparisons on these two companies versus each other on revenue growth, on operating profit margins, on returns on invested capital. And then I'm going to share with you the comparison on valuation on a forward price to earnings basis. And then I'll give you my recommendation, or I'll give you my decision on which one I think is the better one to buy for long-term investors. So that's a lot to cover in a relatively short video. Let's jump right into it after a brief message from my sponsor.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So ARM Holdings has done a great job in boosting revenue as end customer demand for its products has increased. Of course, ARM doesn't manufacture any of its products. Rather, it researches and develops technology, and then it sells access to that technology via licenses and royalties when companies like NVIDIA or Apple or others use its technology to create semiconductors that go into electronics like laptops, desktops, smartphones, tablets, servers based on artificial intelligence, etc. And ARM Holdings is gaining market share versus technology based on Intel's architecture, and now more CPUs are based on ARM's technology, and so it's increasing market share, and that's likely to continue as Intel has fallen behind in this race. Interestingly, Zoom Video has also generated solid revenue growth. The company, of course, was a pandemic darling. Staying at home, working from home necessitated video conferencing, and Zoom benefited as a result. Investors thought when economies reopened, Zoom's revenue would collapse, but that hasn't been the case. In fact, its revenues have held up relatively well, increasing from $4.1 billion in 2021 to $4.8 billion in the most recent trailing 12-month period. I expect Zoom's revenue will continue growing, of course, not at the speed that it grew during the pandemic, but the pandemic was a huge, huge benefit to the company, not just because of the sales and profits and cash flow it generated during the period, but it also received all of these new customers joining and learning how to use the software, right? My kids were doing school from home with Zoom, so they learned how to use Zoom, and so did many millions of people that were working from home or learning from home. They learned how to use Zoom. They installed Zoom on the computer, on their phones, on their tablets, and that install base and that customer adoption, that learning experience that customers got with Zoom is an asset that the company can benefit from for several years ahead. That learning curve, that time to learn, is a huge reason why some companies and some individuals will choose to use Zoom Video in future quarters and future years compared to competitors' offerings, because they'll say to themselves, well, I already learned how to use Zoom. I don't want to learn how to use this new system, whatever that new system might be from a competitor. So even if Zoom's costs are a little bit higher than a competitor, or if the competitor has some other reason that compels and gives it an advantage, the advantage that Zoom maintains from the pandemic usage can give it an advantage and give it some wins against rivals. The next thing I wanted to compare these two on is operating profit margins, and Zoom Video generates operating margins of over 20%, while ARM generated an operating margin of 18.5%. I expect that the operating profit margins for these two companies will continue increasing as they mature. Remember, these are newer companies still in the earlier growth stages, and as they continue expanding their revenue base, as they establish themselves, establish the back office functions, and then grow off of that base, these margins are likely to continue increasing. Similarly, the returns on invested capital are already solid. 20% for Zoom Video, 15.9% for ARM, and I expect these figures will continue rising as well. Finally, I wanted to compare these two on valuation, and there's a big difference here. ARM is trading at a forward price to earnings of 77. That's more than 5 times the forward price to earnings ratio of Zoom Video at 14.66. Of course, I agree that ARM deserves a premium valuation compared to Zoom Video. The total addressable market opportunity for ARM is much larger than for Zoom Video, and also ARM has a stronger competitive advantage versus its competition compared to Zoom Video and its competitive advantage versus its competitors. So it does deserve a premium valuation. However, I believe that premium is overdone in this case. And if I had to pick one of these two growth stocks to buy today, I would buy Zoom Video at its current forward price to earnings ratio of less than 15. I think that's a bargain. Whereas ARM Holdings, I have that stock rated as a hold. I don't even have that stock rated as a buy because I think the valuation is a little bit too rich based on the company's performance and prospects looking ahead. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.